The process of finding and managing a profitable commercial real estate deal has a lot of moving pieces to it, and at the end of the day, this is not easy to do. And in a real estate partnership, the individual or company that puts in the work to identify a deal, close on a property, execute on that business plan, and ultimately sell the property at a profit is going to want to be compensated from their partners for taking on this task. But unless you're an experienced real estate investor or you're actually working in the industry right now, there isn't all that much transparency around what these compensation levels should actually look like. So whether you're trying to figure out what market rates are and what you should charge your investors for your first deal, or you're just trying to make sure you're not getting ripped off when investing in a commercial real estate syndication or fund, in this video, let's walk through 4 of the most common fee structures that exist in the commercial real estate industry today, the ranges I've seen for each, and how to choose which kind of structure makes the most sense for you and your investor base if you're raising capital right now. So to start this video out, let's first talk about the difference between the general partner or sponsor on a deal and the limited partner or passive investor in the property. The general partner is going to be the one that's responsible for finding the deal, raising equity, finding debt, closing on the property, managing the deal, and ultimately selling the property when the time comes. And because of all of this responsibility, limited partner investors are really paying for the general partner's time to find, acquire, manage, and sell a profitable real estate investment on their behalf. So if we know that the limited partner is going to be paying for the general partner's time, what does that payment look like and how are these fees structured? Well, the first fee on this list and the most common I've seen in commercial real estate syndications and fund structures is an acquisition fee. An acquisition fee is really intended to compensate the sponsor for taking the time and effort to find a deal for investors in the first place and for going through the process of running due diligence, raising equity, finding a lender, and ultimately closing on the deal. Now, in my experience, acquisition fees are generally going to be somewhere around 0.5% to 2% of the purchase price of the property, depending on the total value of the property being acquired. Acquisition fees tend to operate on a sliding scale, with the highest percentages usually being applied to the smallest deals, while the lowest percentages are usually applied to the biggest deals. So while you might see a 2% acquisition fee on a $5 million acquisition that sizes out to $100,000, you might also see a 1% acquisition fee on a $20 million acquisition that sizes out to $200,000, since the relative work to close each of these transactions is usually going to be pretty similar. Now, acquiring the property is only one piece of the puzzle when it comes to investing in commercial real estate, and that leads me to fee number 2 on this list, which is the asset management fee. An asset management fee is used to compensate the sponsor for managing the operations of the deal, specifically making sure that the business plan is executed, whether that's raising rents, signing new commercial leases, or improving operations to increase the property's value. This is also going to cover a portion of the company's overhead costs that are required to be able to manage deals on behalf of investors, including salaries for asset managers and analysts responsible for investor relations and reporting, and costs associated with subscriptions to an investor management portal like Juniper Square or AppFolio. Now, as far as the amounts are concerned, asset management fees are some of the most variable on this list because these can be based on 2 very different things. In most cases, asset management fees will be based on a percentage of the property's effective gross revenue, usually somewhere between about 1 and 2% of the total amount generated each and every month. However, in some cases, the asset management fee will actually be based on a percentage of equity invested, similar to the type of structure you'd find in many traditional private equity vehicles or hedge funds, with this number usually falling somewhere between about 0.5% and 1.5% of all contributed capital. Now, obviously, these 2 methods can produce very different amounts, especially in low leverage or all cash transactions, so it's just important to note which method is being used and how this is going to affect your cash flows overall. Now, on the same note as an asset management fee, the next fee on this list is also another fee generated while the property is owned, and that is the construction management fee. Most commercial real estate acquisitions will have some sort of value add strategy that often includes a renovation component, and with this, managing the construction process is another time consuming task that needs to be taken on. And as far as the market norms for this figure, construction management fees usually shake out somewhere between about 4% and 8% of the total construction costs on the deal, but I've also seen these get more specific, being applied to things like only hard costs associated with materials or labor, or even only elective construction items rather than things like tenant improvements that are associated with a lease. Ultimately, the goal here is to make sure that, again, construction management related salaries are taken care of and any asset management oversight that takes away from other business plan activities is also being accounted for. And finally, the last fee on this list moves away from operations and into the final stage of the life cycle of a deal, and that is the disposition fee. And the disposition fee is intended to compensate the sponsor for their work related to selecting a broker, preparing the property for sale, and working through the buyer's due diligence process to ultimately realize returns and produce a capital event for investors. And similar to the acquisition fee, this figure is usually going to be on a sliding scale depending on the size of the deal, often falling in that same 0.5% to 2% range as a percentage of the gross sale proceeds of the property. It's also important to note that disposition fees are owed in addition to any selling commissions paid to a sales broker on the transaction, and even though it might not seem like the sponsor contributes much at this point, managing the sale of a deal often ends up being a long, drawn-out process with several months of preparation generally being necessary before the property can be put on the market. So together, those are the four most common partnership level fee structures in commercial real estate today, but the logical question from here becomes, how do you choose the right fee structure and what is fair? Well, from an operating partner perspective, the goal here is to make sure that your fee structures align with your limited partner interests, but also at the same time fairly compensate you for the work that you're taking on. So with that said, for example, if you know that the deal you're acquiring has a bunch of intricacies that are going to make the acquisition and sale of the deal particularly time-consuming or difficult, but you don't plan to undergo any sort of significant renovation or operational turnaround on the deal, it may make sense to increase your acquisition fee and reduce your asset management fee as a concession. And if you're going into a deal that you know is going to require a significant amount of hands-on management and you plan to hold that property for 7 to 10 years or more, it may make sense to decrease or even eliminate the acquisition fee, but set the asset management fee to a percentage of equity invested on the higher end of the spectrum. At the end of the day, you're looking to create a fee structure that makes the work you're doing feel worth it, while at the same time not overcharging or taking advantage of your investor base. Now, on the limited partner side of things, the best structure for you really comes down to what you feel comfortable with, but most importantly, what those net returns to you will be after all fees are accounted for. I personally like to look at deals based on whether or not the fee structures I'm looking at are comparable to the fees charged by other firms in the same space, whether the sponsor is being compensated primarily to transact and buy and sell a deal rather than based on how that deal performs, and most importantly, how those fees ultimately impact my returns as a passive investor. If the fee load is heavy, but the deal is so good that the returns still make sense, then being on the higher end of the fee spectrum might not be a deal breaker. But if you can get exposure to the same types of deals from two similar firms, but the fee load is significantly lower at one firm versus another, this can really be something to look closely at when choosing between multiple options. Now you'll notice that in this video, I didn't talk at all about equity waterfall structures, and that is because these are not fee structures, but rather partnership distribution split structures that are generally going to be treated and taxed in a very different way. Waterfall structures are also significantly more complex, which is why I have several videos on this channel dedicated exclusively to this topic, and we even have 2 full-length Break into CRE courses which walk through waterfall structures and modeling in detail, so feel free to check out the links in the description below if you want to learn more about these. Ultimately, these are the main fee structures that real estate investment firms are using right now. And whether you're looking to put together a syndication or you're considering investing in a commercial real estate syndication or fund, I hope this was helpful in giving you some context around market rates today and what you might expect to see. And if you want to learn more about the technical side of these fee structures, including how to model these and other partnership structures within a real estate pro forma, make sure to check out our all-in-one membership training platform, Breaking the CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, our entire library of pre-built acquisition, development, and waterfall models for multifamily, office, retail, and industrial properties. And you'll also have access to private one-on-one email-based career coaching if you're looking to break into a top real estate private equity, brokerage, or lending shop and want some additional personalized feedback along the way. And if you like this video and want to see more content on this channel on commercial real estate syndication or fund structures, make sure to hit the like button and let me know. And let me know in the comments if there are any other common fees that you've seen in real estate partnerships that you've worked on or invested in. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.